Okay. Right. Good evening, everybody, and thank you for taking the time to come and hear what we have to say. I hope for the next 45 minutes to perhaps 60 minutes, depending on how much I blabber on, I hope to add some value in your lives. First thing I want to say is we normally hold the webinars in the first week after the calendar quarter. This quarter, we delayed it by 1 month because we felt there was some distractions with the holidays in Israel, and with the imminent ceasefire and return of the hostages. We didn't think people had the bandwidth for a webinar, and we delayed it to November. I think there are two advantages of having the webinar now as opposed to a month ago. Advantage number one, you would have received, as a client, you would have received your third quarter report on the last few days of October. You should be very happy. I'm very happy with Pioneer performance across the board. Depending on the risk profile, the performance is either excellent or very good, depending on, obviously, personal customization that obviously affects performance, but performance is very good across Pioneer, so we're very happy. And we compare ourselves to relevant benchmarks, competitors, and under our family office service, we can see what other managers are doing. So we're very happy with performance, as you should be too. The second reason, which was second advantage about having the webinar a month later, is the discussion we were going to have, the focused discussion of this webinar, which is happening on a daily basis. Clients are asking us, is the market too high? Is the market too high? It was as relevant then as it is now. In fact, heading into October, the first week of October was negative, and I had kind of resolved myself into thinking that October would be slightly negative, not a huge negative month, like a -5 or something. And I thought, okay, well, that's kind of healthy and a little bit expected. So it might ease the conversations if you have one negative month and people are less concerned. But the reality was October turned out to be another strong positive month, over 2% on the indices, on the equity indices. And now the discussion, should we be worried, is even more relevant. So let's dive into it. I want to give you my conclusion first, and then I'll show you some data and some facts. But while I've got your attention, I want you to think about how to approach this issue of, should we be concerned? Okay. If your asset allocation is correct, no, you should not be concerned. There's overwhelming evidence that equities are going to make money in the long term, and you shouldn't try to outsmart equities. When you think of your portfolio, now, how you approach your portfolio is different to how we approach the portfolio. We're managing the money. We're drilling into the technical data a lot more than you would, as you'd expect. But when you think about your portfolio, about your wealth and your money, you need to think on a portfolio level and not an asset class level. A lot of discussion is about the equity market. The equity market is too high. The equity market's at a record. People forget that they have bonds in their portfolios. And this combination of bonds, which are much, much safer, and equities, that's called asset allocation, okay? You've had this discussion with your wealth manager about what percentage equities. Technically, we all should be 100% equities, 100% equities. Why are we not? Because we all have different personalities and we all have different reactions to when the market sells off. And the market in equities will sell off. It doesn't go up in straight lines. There will be negative months, negative quarters, perhaps negative years. And you need to be able to have the discipline to stay invested and not panic. That's why you add in those bond layers. Now, when you think about your portfolio and you think about it on an asset allocation basis and not on an asset class basis, then you can be more relaxed. And if you are that slice, that equity slice in your asset allocation is your long-term investing. And if you are genuinely and intellectually, honestly, and long-term investor, okay, then you should not be concerned with short-term volatility. I'm going to repeat that sentence several times because it's super important, because nobody tells you when the market is at a top. Nobody tells you when the market is at the bottom. There's all sorts of confusing data. But if you stay invested, in your equity slice, in the long term, you should not be concerned with short-term volatility. Okay, so whatever data I present today it should be irrelevant. There's one important condition to that asset, to accepting the risk in that slice of your portfolio, and that is that you have market risk and not single security risk. If you have single security risk, then you need to look at each line item and not your portfolio risk. If your risk is market risk, and in the Pioneer portfolios, we've got a core holding of S&P 500 and NASDAQ, and that is market risk. And that is what allows you to think long term. And not so again, so those clients who have dabbled in single securities, this may not apply. But for your average client who has market risk, and that is your long-term part of the portfolio, you should not be concerned with short-term volatility. Okay, that concept is called asset allocation approach to investing. When under that asset allocation philosophy, when do you sell? All right, when do you reduce your risk? And the theory goes that if there is a systemic risk, if there is in 2008 with the banks crashing, that started to look like a systemic risk. Currently, right now, we do not see a systemic risk at all. Okay, maybe the rise of socialism in the Western world is a systemic risk, but that's going to take 15 years or more to play out. So right now, no systemic risk. So from an asset allocation philosophy point of view, no reason to reduce equity. The other reason to sell equity is if you see clear, obvious signals of irrational exuberance. So clear bubble behavior. And sometimes it's difficult to see what is completely irrational. There are some irrational valuations in the AI world, mainly private deals, less so in public markets. But if there are signs of irrational exuberance, then you need to have a look to see if you need to trim some of the equity, but not all of it. So systemic risk, and there isn't irrational exuberance. I'm going to try to show you that we don't currently see irrational exuberance in the AI theme, and therefore we need to remain invested. So think about your portfolio on an asset allocation level, on a portfolio level, and not an asset class, and then you won't be that concerned. Okay, let's dive into some of the numbers. So year to date, I've got 3 columns here just to show you what's happened in the markets year so far. The first column is year to date to October. I've left in the second column from my Q1 webinar, which was around the 10th of April. I don't remember exactly, but just to see how far the market has come from those lows of April. The last column is the last 3 years from October 22 to October 25. Now, remember, 2022 was a seriously negative year, mainly in the first part of the year. So you look at that column with a little bit of, don't put too much reliance on it because it's not a fully representative 3-year cycle. It's a little bit overly positive. The only thing I'd like to highlight on that third column is NASDAQ over the 3 years has done 134%, and gold has done 145%. So not a huge difference between gold and NASDAQ over the 3-year period. That's all I want to talk about on the 3-year column. On the year-to-date S&P plus 17 from a minus 15, that's about a 40% rise since April. Really, really strong recovery. I can remember the conversations I had with a whole bunch of experts about how Trump's policies and tariff uncertainty is going to dip the world into recession. That hardly happened. So some economic predictions are simply reading the tea leaves. Okay, NASDAQ has done very strong, 23% off, recovered from minus 18 to April. MSCI World is still doing better than the S&P. I'm going to drill into this a little bit more. Tel Aviv has had a phenomenal year, plus 37% in shekels. China's had a very strong year. I'm not going to spend much time on China. We used to have a positive view on China, and that was based on the size of the market and the expectation of integration into the Western world. The integration hasn't happened. The government influence is still strong. So it's still a little bit unclear how investable China is, but it's had a very strong year if it's in your portfolio. Investment grade bonds and government bonds have done very nicely. We've collected our coupons plus a little capital gain as rates have come down. The longer the bond, the better. So government bonds, 7 to 10 year, have done better than investment grade. Israeli corporate bonds have done nicely as well, plus 6%. Remember, in your asset allocation story, your bonds are your conservative stuff. You don't expect to make double-digit numbers on bonds ever. So you're happy if you're just beating cash by a couple of percent. And of course, gold, which we'll talk about in a bit more detail, it's had a phenomenal year, plus 52. Year to date was in April was only 13, and again 145 over the last 3 years. Okay, next. The purpose of this graph on the right-hand side is to show you the equity market over the last 3 years. You can see a very clear trend line going up, but the point I want to make here is it was by no means a straight line. There was some chunky ups and some meaningful downs along the way, which people forget. And this is post 2022. So it's after the 2022 crisis, but still lots of ups and downs. So when these ups and downs happen, you shouldn't be concerned. Again, I'm going to repeat the mantra. A long-term equity investor should not be concerned with short-term volatility. On the left-hand side here, I've got some data this is the overwhelming data about why equities work in the long term, despite the ups and downs. Okay, so 2022, I need to remind you, was minus 25% to the third quarter. 22 and 23 together kind of set each other off. 22 was negative, 23 was positive. The 2 years together was flat. Last 6 years till October 25, the S&P has done 145% or 16% per year. Do I need to remind you what happened in the last 6 years? Ukraine, COVID, Trump, you name it, and still 16% a year on the S&P. Really strong. But let's go further back. 10 years, 14% annualized. 20 years, 11% annualized. 50 years on the S&P, 12%, well, it's 11 point something, also 11. And then 80 years, we still get that magic 11% per year. I just want to explain that these numbers are before any fees and taxes. So it's the index with the dividend reinvested. So it's a little bit better than your average investor would expect. Not all investors are reinvesting that dividend, but everyone's suffering the taxes source on that dividend. So, but still, the numbers are not far off. Okay, the real numbers, if you were investing over these periods, not that ETFs or index trackers existed for 80 years, but if you were invested theoretically in the market, in the S&P, in an index tracker for 80 years, you've achieved 11% annualized. All you had to do to enjoy those high returns was to have market exposure, not single names that your friend or your neighbor recommended, okay? Index exposure and be disciplined. You had to ride through some very, very deep drawdowns. 2008, from summer of 2007 to spring of 2009, the S&P was down 50%, yet still, in the long term, you achieved 11% per year. Okay, this is what we mean by a remaining invested regardless of the story. The story should not matter. What matters is your asset allocation and your risk tolerance. Can you handle those ups and downs? Because not all investors can. History repeating itself. Okay, so the S&P is up 40% since April, breaking its all-time record 30 plus times. So every time that the S&P breaks a record, there's a newspaper article or a social media headline. The client picks up the phone. The S&P is at a record, and we must do something. Okay, the S&P is an index and is currently at 6,700. It launched in 1957 at 100. That means it's broken the record 6,600 times since 1957. It's supposed to break its record. It's supposed to go up over time. So breaking the record is a good thing, not a bad thing. Okay, and part of that 40%, we've seen some. The multiples have not gone up for it. So stock price has gone up 40% by April, but multiples have gone up, meaning using that accounting metric, companies are more expensive, but multiples haven't gone up 40% by April. They've only gone up about 10 or 15% since April. So that means companies are making real money. There's real profit flowing through to the index. And that should give you some comfort that it's not all price driven. There's some real positive numbers coming through. Okay, again, I'll repeat the point. Anyone who feared Trump's tariff policies and sat out of the market missed these recoveries. Again, that asset allocation discipline is so important. Don't try outsmart the market. Corporate earnings are good. There's a wonderful quote, I think it's from Buffett, rather a chunky 15% than a smooth 12%. Rationally, 15% per year is better than 12% per year. But what Trump is saying is you'd rather have 15%, even if it's chunky, if it happens periodically and in spurts, as opposed to a smoother 12%. From a behavioral point of view, some people might prefer the smooth 12%, but that's not rational. Obviously, 15% is better than 12. So you've got to live with those chunky returns, those non-smooth returns that come from the equity market. Okay. It needs to be said, it's extremely difficult. So whatever data I'm going to present in this webinar, it's extremely difficult to say the market is high, the market is low. People tend to oversimplify the conversation over a cup of coffee or whatever, and they make mistakes. You need to stay invested. Okay, there's my mantra. Again, investors, long-term investors should not be concerned with short-term volatility. I'm going to repeat that a couple of times this day. Okay, and just because the market is high, and by some metrics, it is high, okay? By some metrics, it absolutely is high. So it doesn't mean you should sell. Discipline is actually worth better than worth more. Why should you invest? Why should you have that equity slice in your asset allocation? Okay, this is super important because you might say, well, leave me alone. I don't want to be in equities. I just want to be in bonds. Because equities significantly outperform bonds in the long term. If you go back 30 years at the start of my career, a dollar then is worth 50 odd cents today in terms of its purchasing power. Now, you need part of your portfolio to be in equities to at least beat inflation, right? And you're not going to do it in cash or bonds. Maybe bonds a little bit, you might beat inflation, but not significantly. Okay, so that's why you need that equity slice. And strategically, each investor should have the maximum amount of equities for which he can tolerate the volatility, the sell-offs that will come. They will come. Okay, the most spoken about metric about measuring valuation is the price earnings. So the price of the company divided by the profit. Okay, and it means how many years of profit are reflected in the price. And again, this is index-based, so it's all the companies together, not one company. You're using this metric on a single company on an index is different. What's the problem with this metric? Why is this metric imperfect? Firstly, as a trading strategy, it doesn't really work, but it gives you some idea. If you do it consistently, it gives you some idea about where the market's at. What's the big problem with this thing is it ignores the balance sheet. Okay, it absolutely ignores the balance sheet. So, for example, in 1999, when last the earnings multiple for the index was at 29, we're now at 27, 28. I'm pretty sure the balance sheets of companies today is much, much stronger. So if you take away from the price the balance sheet of the company, and you only look at what's called the enterprise value, which is the value of the business without the balance sheet, without the cash, without the property, without all the assets, all right? And then you do the profit multiple, you'll see that it's much more sensible numbers, okay? So don't think that you have to wait 28 years to recover your money if you buy the index. That's not true. It's ignoring the balance sheet. There's a lot of cash. A recent article that Warren Buffett's Berkshire Hathaway is sitting on $300 billion. If you take Berkshire Hathaway and you minus all their assets and then look at their profit multiple, you'll see it's a much more reasonable number, probably around 10, maybe the low double digits. Okay, that's why this number is particularly problematic. Okay, there's two ways to change this number. You can change the price or you can change the profit. And as I said earlier, a lot of profit has come through since April, despite the tariffs, despite the uncertainty around tariffs or policy uncertainty, whatever you want to call it, profit has come through. So we've had multiple expansion, meaning multiples gone up, but it's not all about companies getting more expensive. Some of that multiple is because of profit. That multiple change, is because of profit. Another important point is Trump's big, beautiful bill. He announced a very important tax incentive. Companies can deduct their capital expenditure in the tax year of their expenditure that it comes online. There's some conditions in small print, but basically what that means is companies can build a factory or invest in AI chips or whatever they're investing in, or just a factory or a machine, and they can depreciate it for tax years fully in the year that it comes online. And that means their tax bill can be significantly reduced. Now, not every company was able to do that in the third quarter. Meta or Facebook spent a staggering 17 or 18 billion dollars on capex in one quarter. All right. So this is going to really help their tax bill, and an improved tax bill means improved profit, which flows through to us as investors. Okay. So the tax story is still is part of the reason for the bull case. The strong balance sheets is a reason for the bull case. The AR theme, we still have legs, another reason for the bull case. So if we look purely on the metric of multiples, yes, the market is high, no doubt about it. But God is in the details, and perhaps it's not as high as we think it is. Okay, another risk, and this is more on the bear case, arguably, but not definitely, is the concentration within the S&P 500. Okay, this graph on the right shows from 1980 to 2025, the relative size of the 10 biggest stocks in the S&P 500. And you can see at its lowest point is 17.5, but we're currently at 39%. 39% of the S&P 500 is 10 companies. That means 60% is 490 companies. Okay, so that's starting to look a little bit heavy. So that kind of supports the bear case, but it's a little bit heavy. Should we be concerned? Well, if every single company in the world and most households are either using an Apple product or a Microsoft product, maybe we shouldn't be concerned. Maybe those companies are so strong and so big for very good reasons that we shouldn't be concerned. Okay, but concentration risk is elevated and we need to take it into account. Just some data to give you some idea of how concentrated. NVIDIA, with a market cap of touching 5 trillion, is 8% of the S&P, which is the largest ever for a single company. NVIDIA, Microsoft, and Apple, these three monsters are, and remember, everybody's using their product, and companies are going to use NVIDIA's product. Either they're buying those chips directly or they're going to rent those chips through Amazon or through others. And so those three companies are 21% of the S&P, and the top 10 holdings, as I said, are 39%. So that's one thing to bear in mind. Now, is there an AI bubble? This is a question we're facing on a daily basis, and there's very different ways to try and explain it. When we're looking for a bubble, we're looking for irrational exuberance. So here's a comparison between valuations, profit multiples with their problems from 1999, the four biggest companies in 1999 and the four biggest companies today. So Cisco was trading at a profit multiple of 130. Oracle was trading at a profit multiple of 120, Microsoft 60, and I promise you their balance sheets were a lot weaker than they are today. So compare those valuations to today's four biggest companies. And yes, these multiples look a little bit high, but their balance sheets are strong. And these companies are much, much stronger. And we're nowhere near 1999 levels. In addition, it's not even irrational valuation. So currently, at the level of the index, we don't see an AI bubble. We are hearing about deals done in the startup world, in the private market world. We're hearing about deals with very high valuations, and that may filter through. So the AI story may become a bubble, but we don't think we're yet at a bubble story. An interesting thing here, if you would have bought Microsoft in 1999 at a 60 multiple and a weak balance sheet, or certainly weaker than today, and you held that stock till today, you would have made about 12 or 14 times your money. All right. If you would have bought Cisco at 130 a profit multiple and held it till today, you only sort of broke even around about 2019-20. So again, it's so important to think about risk, whether you're index-based or single stock-based, okay? Because it makes a huge difference. On the right-hand side here, something is missing, and that is Tesla. If Tesla was here, the column Tesla's profit multiple is touching 200. It's some crazy, crazy, crazy high number. In my mind, Tesla is a bubble. Tesla is ridiculously overvalued. Not everyone agrees with me, even on my team, but I think Tesla's ridiculously overvalued. If I could buy the S&P 499, meaning without Tesla, I would do it, but I don't have that option. So I'll buy the S&P 500 and live with the Tesla exposure inside there. But I think Tesla's hopelessly overvalued. Time will tell. People, originally it was electronic cars, then it was data. Now it's all about robots. Okay, if Tesla can bring a robot which will clean your house for $500 a month, it might justify that very high multiple. I'll happily take 2 robots to clean my house and eat humble pie at the process. All right. Okay, US dominance. So this slide is meant to address the question more about Q2. So up until Q2, the MSCI World Index was outperforming the S&P, which is something we almost never see, right? The S&P is almost always leading the World Index, but for once we saw the MSCI World do better. So I just wanted to show you some data here. And it's mainly coming from currencies, to give a long story short. So S&P is plus 17% to year to date. Last 20 years, 736. MSCI World 21, so better than the S&P. Last 20 years, 465. Now, the S&P is about 55 or 60% of the MSCI World. So that means the rest of the world is doing terribly compared to America. And let's look at Eurostoxx, the main index of Europe. And it matters tremendously if you look at it this year in dollars or in euros. So the euros, because the dollar weakened so much this year, I'll show you some data on that as well. Eurostoxx 50 in dollars plus 32. Looks great. Most people don't buy the Eurostoxx in dollars, but or if they do, it's often hedged. So not many investors enjoyed that. But Eurostoxx in euro, 19%, which is quite similar to the S&P in dollars. But take a look at the long term. Over 20 years, the currency issue has kind of worked its way out, and you get roughly a pretty similar number over 20 years, 244, 259. So Eurostoxx way behind the US. It supports our thesis of why we should be overweight USA. Dollar weakness, this was also more of a story around the second half, up until the second quarter. We expected a recovery. There has been a little recovery in the dollar. At its worst, it was about minus 11 and point something. It's now minus 8. And how do you measure currencies? You measure it against another single currency or a basket. You normally talk about the dollar as against a basket of currencies, mainly the euro. So the DXY is the most commonly used basket. It's 57% euro and then a bunch of other stuff. Yes, the dollar is weaker, roughly 12%, 10% weaker this year, no doubt about it. But let's take a longer term view, the same basket, the DXY, and you can see that, yeah, we've had ups and downs in the past. We had a strong up in the early 20s, and now it's some up and down, and now it's given some back. So some dollar volatility, it's normal. I'm not panicked by the dollar. I don't buy the conspiracy theories that Trump's weakening the dollar. I don't buy any of that. Bet against the dollar at your peril. The dollar is still the strongest economy, still the reserve currency of the world, and there doesn't appear to be a second place in that respect, despite whatever attempts you read about. So I wouldn't put too much emphasis on this weak dollar story. some new information about the US economy in general. Mostly good, some signs of weakness, but mostly okay. Real GDP growth fell in Q1, but recovered strongly in Q2 against all the tariff nonsense. Net exports were a problem in Q1, but they recovered strongly in Q2 against all expectations. The growth forecast now, because the government shutdown, there's a delay in all sorts of data. So the expectation for Q3 is very strong. Again, some of those economists were predicting a recession from the tariff uncertainty. Nonsense. Very strong growth in Q3. Q4, we expect a positive growth. The government shutdown is going to affect things. So a little bit of negativity there, but nothing major. Still a positive quarter from an economic growth point of view. Robust consumer spending continues to drive growth. The US economy is primarily a consumer economy, and the consumers are wealthier than they've ever been, and they're spending. On the negative side, the amount of people who have the purchasing power, the spare purchasing power, those number of people are shrinking relative to the total population. And that's one of the reasons you see this rise of socialism in parts of America vis-a-vis the election yesterday. Okay, wage growth is growing. So if you've got a job, you're generally earning ahead of inflation. Home sellers significantly outnumber home buyers. All right, this is going to put pressure on the prices of houses in the market, and still by any metric, if you look at the average price of a home compared to the average earnings, that's affordability. The affordability of houses in America has never been as bad as it currently is. Okay, again, some of the rise of socialism in New York is definitely because inflation, things are so expensive there. There's some weakness in the labor market, not much, but it's mainly about job growth slowing. So unemployment is still strong and a low number. It's never going to go to zero, but it's a very low number at 4.3. But job growth is slowing. Is this an AI consequence? Maybe, maybe not. But certainly AI is influencing certain types of jobs in certain industries. Gold. Okay, I've gone on record on these webinars in the past, and I've said I don't like gold. I said the link between inflation is too difficult to understand, and we avoided gold. Okay. When Corona started and when government stepped in to rescue markets and rescue businesses and people and did this insane and irresponsible printing of money, for lack of a better word, not technically correct, but they printed a lot of money. We had a discussion in Pioneer, should we buy gold? Because it's natural to expect some inflation following this. After a discussion, we decided to buy NASDAQ instead of gold. And this turned out to be absolutely fine. So the NASDAQ over the 5 years has done 143. Gold has done 119. Most of gold's gain is in the last 18 months. Now, gold has had a phenomenal time. Okay, it really has had a huge rise. And the last time gold had such a strong rise was in 1979. So that kind of supports my thesis that I don't want to hold an asset that does well, that has a brilliant time every 45 years. So that's one reason not to hold gold. But the main thing about gold is what we try to do when we manage money is we want a lower volatility, and we want as much as possible predictable returns, as much as possible, right? We want something to predict. We want to base our expected return on something that we can predict. And gold is very difficult to predict. The drivers of gold, right? Gold has a jewelry demand, international jewelry demand, very hard to predict. Central banks who are buying gold, very hard to predict. They may dump, they may sell, they may increase. We don't know what drives central banking thinking, and it's not all China. If you Google who's buying gold, which central banks are buying gold, you'll be surprised what you find. Okay, the next player in the gold market is gold mines. Gold mines sell their gold forward on futures contract. Okay. And then the last player in the gold market is the speculators or the hedge funds that are trading those gold futures contracts. Now, we don't know how any of these, and I don't think it's possible to know how these influences play the gold market. So we step out, okay? While you hold gold, if you're going to hold gold, then you don't get coupons, you don't get dividends, you just get volatility and the hope that it catches up. Now, Corona started in 2020, and inflation only kicked off in 2022 following the Ukrainian invasion and the energy crisis in Europe. And then suddenly there was inflation in the United States. And then gold only started to run in 2024. So that timeline kind of supports my thesis that the link to inflation is difficult, let's say. All right. So there's a 4-year delay between the money printing, the signal that there will be inflation, and the result of that inflation on gold. So 4 years is a long time to wait for returns. Okay. Okay, relative to inflation, gold is now caught up. For many, many years, gold was way, way behind inflation. But because of this boost, it's actually overtaken. So inside the gold price of 4,100 or 4,000, there's an expectation about future inflation. Okay. Now, I would say the probability of 3 something is higher than 5 something. But again, my ability to predict this animal is quite poor. But normally what you see is after such a strong run, it normally gives something back. So we're not buying gold. We may in the future if my team convince me, or if there's some clear signal that we should. But currently, I'm sticking with my guns. And because we held NASDAQ, I don't believe anybody gave up any performance over the last 5 years, or even over the last 3 years is not that much. And we shall see what will happen in the future. Bonds have done great this year. We've collected our coupon, and there's a little capital gain as the 10-year rate went from 4.5 to 4. Beginning of the year, we predicted it would be between 4 and 4.6. And we're certainly at the low end of that range. So we're a little bit more concerned about duration risk right now. Spreads are tight, meaning we're not going to earn extra over government bonds as much as we used to, but we're still earning a pickup over government bonds, but not as much, especially on the high quality bonds. Sophisticated credit, which is an area we like and we're exposed to, has done exceptionally well throughout the volatility of April. Very happy with those assets and contributed to performance positively. And I need to say this a little bit. Not everybody understands bonds, but in April, conservative investors were absolutely blessing them. They worked. They helped control the risk, all right? And they helped control what the emotions around managing wealth. So they worked very well this year. Short-term rates are coming down. You've heard this in the news recently. It's now 3.75 to 4. And at least the market is expecting further rate cuts. I'm not sure it'll be in December, but maybe early next year we'll see some more. This creates a bit of a dilemma, I think, because inflation is still a little bit too high. This slide shows core inflation from 22 to 25. And you can see inflation is in the high 2s, right? 2.8, 2.9, 2.8, 2.9. It should be at 2. If the Fed target is 2. So why would they reduce interest? It doesn't make sense. The Fed have 2 jobs, right? 1, control inflation. 2, control or influence unemployment. That's their mandate. Inflation hasn't come down all the way, but they reduced interest rate. Is it political interference? Is it some other reason they want to grow they want, more economic activity, lower interest rate? Is it because too much pressure on the property lenders? All sorts of theories behind why they continue to reduce interest rates. I personally think it's a mistake. If inflation is controlling inflation is the target, then it's the wrong time to reduce rates. But they've reduced rates twice. lately. And this supports the view that I think the Fed are going to let inflation tick higher than 2 and just accept it. Why? Because of the national debt. Remember, America's got way too much, it's got World War II levels of debt relative to the size of the economy. They're not going to go bankrupt, and they're not going to repay. They're not going to have fiscal discipline in order to improve that level of debt. The only way is to inflate the economy slowly, very slowly. Remember, inflation was one of the main reasons why the Democrats lost the election last year. And next year, November, are midterm elections. So inflation is going to be a big issue. If it remains under 3, maybe it'll be okay. But if it goes over 3, I think there'll be some pressure to increase rates. Okay, money supply. This is a little bit technical. People talk about liquidity or money supply. So there's, which is controlled by the central banks. Money supply is good. This is part of the bull case, okay? Money supply filters through to all assets, and yes, it's inflationary, but it also is one more reason to stay invested as opposed to de-risking. Right, now let's move over to the Israel side, Tel Aviv has done phenomenally, plus 36. These indexes are not very deep, okay? There are not many companies in these indices, but still, banks, Israeli banks, plus 47, insurance, plus 112. They were punished before, but in the early part of the war, so very strong recovery from the insurance companies. Real estate, plus 27. Notice real estate is the worst of all of them. There's some pressure in commercial real estate in Israel. All of the oil and gas index plus 51, and just for reference, S&P 17, FTSE in sterling 23, and the DAX, the German DAX, plus 20. So Tel Aviv has done, despite the war, despite all our challenges here, the Tel Aviv Stock Exchange has done phenomenally. And if you do that in dollars as well, with the strength of the shekel, it's even stronger. Okay. So just a little bit of a dive into the Israeli economy. We look at Israeli economy is primarily services based, and we look at services exports. Forgive the Hebrew here on the right. This black vertical line is the start of the war, and the blue line on the top is total services exports. The gray line is high tech. How they define high tech is a little bit complex. I'm not going to go into it, but their definition of high-tech exports has increased throughout the war. The dark line is the services without high-tech, flat. And, of course, the yellow is tourism, which has been decimated through Corona and the war. It's been absolutely decimated. So don't expect major tourism resources in Israel. CDS insurance, I spent time discussing this on the last webinar. Bottom line here, the cost of government debt has gone up since before the war, but significantly down since the Beepers incident last August, September, okay? And this should give us some comfort that the risk of Israel in the eyes of the global bond world has come down. Inflation, post-war inflation is talked about a lot. So here we've got some data, Yom Kippur, and then we look at the year after, the calendar year after the war. Yom Kippur was 73, inflation 1974 was 56, Lebanon War 1982 to 98. The main fighting was 1982, but it carried on to 1985. Inflation 1986 was 19, Iraq War 91. So what you can see here through each of Israel's military campaigns, greater and greater fiscal discipline to keep control of inflation. Post 7 of October war, the official estimates of inflation are around 2%. We think the Pioneer team is a little bit more skeptical and think it's going to be closer to 3%, but still that's a relatively low number given the history of Israel. Again, that's a positive for investing in Israel. We've looked here, the parallel we've drawn here is 1991, 1993, because that was the Oslo Accords. Okay, following the Oslo Accords, there was an absolute boom in Israel. Foreign company investment, American supported investment. So Oslo was really, really very positive. We think the same thing is going to happen from the Abraham Accords. Even if Saudi doesn't join, and we think they will join at a certain point, if Saudi joins, it's going to be even better. All right. So that's why we've chosen these particular years. 1993, here we're looking at the Israeli miracle in numbers, GDP per capita. So 1993, France, 22,000 per head, 13th in the world. UK, 20,000, 18th in the world. Israel, 14,000, 25th in the world. South Africa, for those who are interested, I know there's some people on the call from South Africa, 3.7 thousand, 54th in the world. 2024, Israel's beaten these other countries, gone up from 25th in the world to 20th. UK has gone from 18th to 23rd in the world. France has gone from 13 to 27th in the world. And South Africa, absolute disaster, 54th to 110 in the world. Anyways, so another way to look at this is to compare how the Tel Aviv Stock Exchange has done to the S&P post Oslo, and then from roughly 2014 till today. And the message here is Israel did extremely well, even better than the S&P following the Oslo Accords. And then from 2014 to 2024, even Israel was way behind. Okay, so now we recognize in the S&P number here, there's that mega cap influence. Even if you strip out the Apple, Microsoft, etc. influence, there's still arguably some catch-up that has to be done, Tel Aviv versus S&P. Why diversify to shekel? I think this is particularly relevant for the people on this call as opposed to the people on the Hebrew webinar here from yesterday, because most English speakers in Israel are underinvested in Israel. We have had a very interesting pickup in demand for clients or potential clients out of Australia, Canada, England, America to have money in Israel. They're feeling the anti-Semitism. They're feeling the fear in those countries. They want exposure to Israel. They want to invest in Israel in liquid securities, not only in property, not only in high-tech stocks or startups. They want to invest in simple, plain vanilla liquid portfolios in shekels. We've seen a significant uptick in that demand. So we want to be in shekels. It's a strong currency. If Saudi joins the Abraham Accords, you can expect a faster appreciation of the shekel. It may break the 3 number and have a 2 handle, 2.9. Lots of profitable and stable companies in the Tel Aviv Stock Exchange. Foreign investment is returning. The geopolitical landscape is the Abraham Accords. And of course, the biggest issue for immigrants to Israel, match your expenses with your earnings in the right currency. Aliyah is hard enough. You don't need that risk as well. Looking forward to 2024, looking forward to 2026 and balance of the year. We're cautiously optimistic about the US economy and the Israeli economy, especially the Israeli economy. Markets are high. Markets are high. Remember what I said about asset allocation. Occasionally, risk assets sell off. So what? As long as your asset allocation is okay, then you should not be concerned about short-term volatility. The AI theme and Trump's tax incentives has still got some good news to come through to the market, so that should give you some comfort. Short-term rates trending down. Midterm elections next year, inflation is going to be a big story. Some questions received on registration. Okay, I haven't edited these. These are straight copy and paste as they came in. Are shekel portfolio values going to be volatile through Trump's plan? Yes. Why? Because they're always volatile. So equities are volatile. It doesn't matter whether it's from Trump's plan or whatever. If Israel returns to war, will Israeli prices nosedive? They'll go down. They'll go down. I don't think they'll go down to pre-war levels because there's a lot of confidence around Israel's military abilities. And Gaza's influence on Israeli economy is limited. Iran is a different story, but certainly Hamas is a less significant thing. What's the next sector to invest in since tech stocks are so high? Well, you want tech. Tech is used in absolutely everything by every company. You don't want to give up on tech. So you can look at sectors. We are looking actively at sectors. I don't want to go into them. The big one being researched right now is the electricity demand. There's going to be a shortage of electricity in the future, and we want to see who's going to benefit from that because these AI machines are just chewing up electricity. Forecast for 26, I said economically positive. Markets are markets. Think of asset classes in terms of their fundamentals, not in terms of any story. Gold, I think I explained the gold story. And I kept your comment as is. I'm not ashamed of the decision we took. Direction of the shekel, we think the shekel will continue to strengthen. Is it time to sell investment bonds that have been doing well in very much? No, because what else are you going to buy? For that risk profile, bonds are still doing their job. We're kind of selling 2-year bonds and buying 6-year bonds. We could be buying much longer, but we're a little bit cautious about that. So 5 or 6-year bonds is okay. We're just trying to get a little bit up, a pickup in yield. Will the dollar go up? Again, I think only if there's some sort of crisis in the world will the dollar shekel. I don't know what you mean about the dollar. The dollar versus that basket of currencies that I showed, I think the dollar will recover. We're not sure when, but it will recover. And again, this is not something that should be directing investment decisions, okay? It's not something private clients should be worried about at all. Can you recommend defensive measures in a bunch of currencies? Yes, quality bonds. Quality bonds are still giving a pickup over the cash, and they're excellent defensive. Obviously, you need good bonds and a good bond selector, but generally doing absolutely fine and are definitely a defensive investment. Okay, that's a wrap. Thank you very much for your time. Just shy of 1 hour. Let me just have a look and see if there are questions coming through on the Q&A. I don't see any. Okay, good. Thank you. That's a wrap. Be well.